Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, Eitel.
All right. Hey guys, it's Mark Eitel, and you are listening to the Mr. Mortgage Show. Man, oh man, I am super excited to be with you this week. We've got an awesome show lined up for you. We're going to deep dive some data. We're going to take the emotion out of it. You hear me say it all the time, that emotion and logic can't run the same brain at the same time. And I don't think real estate ever makes sense as an emotional decision. Emotion might be what starts the process. You might get excited. You might really be infatuated with a neighborhood, but it's got to be a logical decision at the end of the day, because we're talking about, you know, hundreds of thousands and sometimes millions of dollars on the line when you're making these big decisions. So we're going to dive into all of that this week. But before we get started, I just wanted to say thank you, a truly heartfelt thank you from both Jen and I. She's back there on the phone, or I'd have her pipe in, but she received a couple of calls while we were on the air last week, and we got a bunch of emails wishing me to get well soon, right? Feel better. Because if you heard last week's show, you know I got hit with that flu bug. It's still lingering a little bit in my voice, although I feel like a champ today. Last week was a struggle to get through the show, and thank you guys for bearing with me. It was an important show. I really wanted to do last week's show because of all of the social media buzz around this housing market explosion, and you got to get in now. And you know my feelings on that. We talked about it in length last week. I just don't want people to overextend and feel like they've got to make up for lost time, because sometimes you miss the elevator. Sometimes you miss the escalator, and you got to take the stairs. You know, that brings back a memory. I used to fly quite a bit, and I flew Delta a lot. And I was in the Atlanta airport on more than one occasion. And the train or the tram, I don't know what you call it, but that takes you between the terminals. It's down in, I don't know if it's a basement level, but it's down on, let's call it the first floor. And there's one terminal in particular that I remember this to be the case on many occasions, that depending on where you get off the train, if you get off the train towards the middle of the train and you walk forward and turn to your left, well, there's this very, very steep escalator that takes you up to the gate level. And it's probably the equivalent of about 4 stories, I would think. And if you don't get off the train in the middle and you don't know where you're going, if you're further down the train on one end and you get off, the stairs are to your left. Well, the stairs are a much more arduous task than the escalator to get up to that 4th floor, if you will, or to the gate level. And I've done both, guys. I've done both, and the escalator is far more fun. And what I'm alluding to is maybe the opportunity to buy in 2019 or 2020 with 3% or 4% money is the equivalent of the escalator. And buying in 2024 at 6.5% money is the stairs. Well, my point is, you're still going to end up on the 4th floor at the gate level. You might not get up there as quickly, and you might not have the extra time and money for the Starbucks and the panini, but you're going to get there over time. And guys, equity changes your life. It makes sense to buy a home if you can afford the home. And that's a big if, right? Because if you're working from a budget number, and that's what you should be working from, $2,000 a month buys a very different home today than it did just 3 or 4 years ago. So I just want to get that out of the way, because a lot of people said, it sounds like you're down on buying property. And that's not what I'm saying at all. What I'm saying is, don't get emotional about buying property. I think real estate always makes sense. If you look at the St. Louis Fed's graph on housing appreciation historically in this country, I think it goes back to 1970. Man, it's undoubtedly a good decision. Over time, you're going to build equity, and equity's real wealth, guys. It's real wealth. Oftentimes, and again, if you bought at 2019 and took that escalator ride up, you know the house will do a lot of the work for you when it comes to building equity. So anyway, just just wanted to get that out of the way. I know I got some comments on that after last week's show, and if there was any misunderstanding, I wanted to clarify. Not at all down on buying, just down on buying for the wrong reason. I said it's not Bitcoin, right? Don't get caught up in the emotion. If you don't think it all the way through, you don't plan for the tax increase, you don't plan for the insurance increase, you're going to be disappointed on the other side of it. And don't start paying over appraised value and waiving inspections and waiving appraisals and all of that craziness again. Man, imagine where we would be today if that very first person that started that craze didn't do it. That very first agent who said, hey, Mr. Buyer, I've got this great strategy. Let's just give them everything and then some and not even look under the hood, right? Let's just hope this car runs and take it. We're going to give them more than they ask and we're not even going to inspect it. Imagine if that never happened, where we'd be in this housing market. I bet it would be a very different market. So anyway, I am as excited as everyone else about mortgage rates falling back a bit. I'm just not blindly going down the Pied Piper path that they're going to end up at 4%, because I look at the data and I don't think we see a 4% interest rate in 2024. As a matter of fact, I'd be willing to bet that we don't get close to that. So I hope I'm wrong. 4% money is a lot easier to write mortgages at than 6 or 7% money. I just don't see it. So, but one thing I'm excited about the lower interest rates doing, at least in my practice, and guys, if you're unaware, we are much more than a mortgage show. We are a national mortgage brokerage team. So we're helping families every week from coast to coast, everywhere but New York, with their mortgage needs. And one thing we're seeing where people are capitalizing on lower interest rates, buying properties, obviously it's cheaper to buy at a 6.5% or 7% interest rate than it is at an 8% interest rate. But a couple places people overlook is in the reverse mortgage space, the amount of equity you have, your age, and the current interest rate dictate the amount of equity you have access to with the reverse mortgage increases as interest rates decrease. So we're seeing more favorable proposals being generated. By favorable, I mean more access to equity in our reverse mortgage practice across the board. It's more exciting to see those numbers at 6.5% or 7%. Versus 8.5%. And then the other place is debt consolidation. A lot of people were on the fence about doing a refinance if they had a rate in the 4s or 5s, paying off the car and the high interest credit cards and whatever else they've accumulated over this, COVID spending flurry that we all have gone through. Well, if that interest rate is at 6.5%, that spread is more favorable. So going from 4% to 6.5% is certainly more attractive than 4% to 8%. But also, too, buying 6.5% down to 6 or 5.875 makes that even more attractive and sets you up for more monthly savings. So we're seeing that as well. Overall, I think it's a cautiously optimistic market. I'm just not buying into the social media craze that we're in for a housing explosion in values or supply in 2024. And I'll say it again, guys, if supply shut off when interest rates crept into and past 5%, what makes you think it's going to turn on again when interest rates are at, 6.75%? It's just not logical. So if interest rate increases slowed supply because people didn't want to sell and then buy into a higher interest rate environment, until we get back down to that gap being smaller, interest rate can't be the trigger for people selling. Now, having to move, having to upsize, downsize, all of the things in life that happen, there's always going to be sellers and there's always going to be buyers. I'm just saying I don't think rates have become a tripwire for activity yet. So we're going to watch that. But right now, we're still in a healthy appreciation cycle, and there's demand in the market. I am still high on homeownership. I think equity changes lives, and whether it's the stairs, the elevator, the escalator, or a rocket ship, it's going up over time. Just look at the data. So, guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you heard the man, the Anytime Hotline. That's how you get your questions on the air. You can call or text that number, 855-462-7292. That's 855-462-7292. And Jen is womanning the Anytime Hotline, and she will get your questions on the air. If you prefer to do it online, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page is a big orange button that says Get Your Questions on the Air. If you click that button, you can type your question in, hit submit, and it'll pop up on our end. Jen will read it on the air for you. Again, that's MrMortgageRadio.com. And guys, I encourage your questions and comments. We couldn't do this show without you. We definitely need your participation and appreciate it each week. I know we've already gotten a couple questions that have come in, so let me throw it over to Jen, and let's start with the questions. Hey, Jen, you ready?
Rhonda sent us this. I have 2 questions. What is the minimum credit score requirement for a reverse mortgage? And can we use the cash for home repairs, specifically a new roof?
Hey, Rhonda, 2 very, very good questions. I'm going to start by answering question number 2. Yes, you can definitely use the proceeds for home improvement, for remodeling, renovation. If you wanted to consolidate a bit of debt, if you wanted to pay for medical expenses, there's a lot of liberties with, what you can use the proceeds for. It's your money. So yeah, definitely a new roof. I wouldn't suggest going to Vegas and pulling the slot levers, but yeah, a new roof certainly is not a problem with the cash out from the reverse mortgage. Now, the interesting answer, if you will, I'm hoping it's interesting, but the more interesting question, at least for me, is the minimum credit score. So the reverse mortgage is very unique compared to most mortgage products in that it's not credit score driven. So it's not as if there's a minimum credit score that has to be met before you can be underwritten for the program. Now, with that being said, there is a financial assessment that's being performed, and that financial assessment includes credit review. But your score is not being looked at. Your ability and willingness to repay your debts is what's being looked at, because even though the reverse mortgage doesn't require a monthly mortgage payment, you still have to pay your homeowner's insurance, you still have to pay your taxes, you still have to maintain your property. So the purpose of the financial assessment is to determine whether you have the ability and the willingness to repay your debts. Now, one thing I can encourage you is that if for some reason you don't, some people are just unable to manage their finances at some point. And there's a workaround in those circumstances. It's called a LESA, L-E-S-A. It's called a life expectancy set-aside account. And that account can be set up to escrow things like your future tax payments, your future homeowner's insurance payments. So even if you have troubled credit, there might be an opportunity still to do a reverse mortgage. But to answer your question, there's not a credit score requirement. It's the financial assessment and your ability and willingness to repay the debt, which is evaluated. So I hope that helps. And I would encourage you, if it's something that you're considering, and if you know something about your credit that has you hesitant, just give me a call and we can talk through it. A late mortgage payment, some medical judgments, those type of things pop up. In a lot of instances, we're able to work around those with the reverse mortgage. So I would encourage you to at least have the conversation. I'm happy if it's with me, but if not with me, with somebody, because again, there's not a quote unquote minimum credit score requirement with that loan program. But for the right person, man, it can be a powerful, powerful tool. So great question. I appreciate that. I always enjoy talking about the reverse mortgage. So anybody who has questions about reverse mortgages, please don't hesitate. Hey, Jen, throw me another question.
Stephen has this question. I know the landlord loan doesn't look at my income, but what about my assets? Beyond the down payment, how much more do I need?
Great question. I love talking about the landlord loan. Hey guys, the landlord loan, if you're curious, if that's a term you haven't heard before, it's a loan program that's designed for people to buy rental properties, right? And the very cool thing that Stephen alluded to is we don't look at your personal income. We're looking at your credit and we're looking at your assets. Do you have the down payment? And to Stephen's question, in addition to the down payment, how much more do you have to have? Those are called reserves. And depending on your credit score, because every other loan program other than the reverse mortgage does have credit score requirements, depending on your credit score will determine whether you need 3, 6, or 12 months reserves. So you could need, Stephen, as much as your down payment plus 12 months reserves. And those reserves would be the equivalent of the monthly expenses. So the monthly expenses times 3, 6, or 12 months is what you would need in addition to the down payment. So I hope that helps. And again, guys, if you want to talk through a very specific scenario off the air, I welcome the opportunity to jump on a call. Please feel free to shoot us a scenario. I'll answer it on the air. But if we need to go deeper, I'm always available to jump on the phone. But Stephen, it's usually 3 to 12 months reserves depending on your credit score and depending on the program. And again, we're not looking at your income, but you've got that already figured out. So great question, my man. I appreciate that one. And guys, that's another thing we're seeing a lot of people use the equity that they have. You heard me say in the opening segment how important equity can be in the future. There are a lot of people who will take an equity line on their property and go out and buy a rental property and let the renter pay the mortgage on the rental property with something like the landlord loan and repay their equity line, because it's got to make sense, right? It's not emotional. Remember, it's data driven. So if the rental income will pay for the equity line and the rental income will pay for the mortgage payment and hopefully some profit, let the renter go in there and pay that debt down for you while you build equity in that investment property. It's called self-liquidating debt. It's one of the few places in life that someone else will build the equity for you. So, man, I love talking about the landlord loan in all of the ways that you can use equity. See, guys, I'm not down on real estate. I'm excited about real estate and the opportunity that equity creates. So, hey, Stephen, thank you for that one. I hope it helps. If you need more information, just reach out. I'm here and happy to help. Hey, guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
Hey guys, it's Mark Eitel, and you are listening to the Mr. Mortgage Show. If you want your questions on the air or your comments, call or text 855-462-7292. That's 855-462-7292. That is the Anytime hotline. And Jen is womaning the hotline and she will get your questions on the air for you. Or head over to mrmortgageradio.com. That's mrmortgageradio.com. And right in the middle of the page, you can't miss it, there's a big orange button that says Get Your Questions on the Air. Just click that button, type in your question, and it'll pop up over here. Jen will read it on the air for you. But hey, let's get right back to it. We had some good questions there that last segment, and I'm going to throw it to Jen, and we'll keep your questions rolling here. Hey, Jen, go ahead when you're ready.
Here's a question from Wayne. I know you've talked about this before. How does the REC refinance calculate my debts? It's different than a HELOC, right? My bank denied me for a HELOC. That's why I'm asking.
Hey, Wayne, great question, my man, and thank you for paying attention because we do talk about this one from time to time. That's one of the exciting things, I guess there's nothing really exciting about debt, right? Let's be honest. As much as I get excited about some of the opportunities that debt provides, it's not exciting to go into debt. Who are we fooling? But hey, back to your question. When you're doing a home equity line of credit, you're being evaluated as if that's another debt on your credit profile. So if you've got 2 car payments, 2 credit card payments, a boat, and a house, well, then now, boom, there's an equity line of credit. And if that equity line is, let's say, for $100,000, your equity line payment in your debt calculation is going to be based on $100,000. Because of that, you need to have enough income that when your debt to income ratio is calculated, right, the amount of debt, including the new $100,000 credit line, the equity line, is there enough income for that ratio to work? What is the ratio? Is it 50% debt to income, 60% debt to income? Every bank's underwriting guidelines are a little bit different because that equity line product is something they keep on their books. Now, with the REC refi and REC, REC, REC stands for reduce, eliminate, and consolidate because it's a debt consolidation that oftentimes will allow you to reduce your monthly payments. So it's a debt consolidation refi is basically what it is. Your 2 credit cards, right? The boat and the 2 cars. Let's say you're going to pay off both cars and the boat. Let's say you don't have big credit card balances. Well, it doesn't matter what you're going to pay off. You can pay it all off. The debts that are going to be paid off can be paid at closing. When you close on the refinance, any refinance has a 3-day right of rescission. So 3 days later, the title company will disperse, it's called, right? They're going to disperse the funds, and they'll send a payment to credit card 1, a payment to credit card 2, the same to the car payment 1, car payment 2, and boat payment on your behalf. Because that can be facilitated at closing, the underwriters know those debts are no longer going to be on your credit profile. So they can be taken out now. So all of that debt can be removed from your debt to income ratio. And oftentimes, not always, but oftentimes, if the debt to income ratio is what prevented your home equity line from being approved, then the REC refi or the debt consolidation refinance strategy may be an option for that very reason, because the calculations are done differently. We can control, when I say we, the lender can control what's being paid off by instructing the title company, pay all of this off before you disperse the rest of the proceeds to the borrower. So that's the big, big difference in doing a debt consolidation refinance versus an equity line. So I hope that helps. That's a great, great question. And if anybody out there is curious to know if a REC refinance can save you money, even in this interest rate environment, we talked about it in the opening segment. We're seeing people take advantage of this slight pullback in interest rates and knock out some of this debt. I mean, what was it last year? We crossed the $1 trillion mark in credit card debt. That's mind-blowing to me. But you can go to recrefi.com and run the calculations for yourself. And guys, you don't have to type in your information. It's a free tool. We put it up there for you. You can also find it at mrmortgageradio.com. Play with the calculator and see what you think. And if you have questions about it, call us. We'll be happy to walk you through it. Sometimes it makes sense, and you're surprised to see what you could save each month. So great question. I appreciate that one. Hey, Jen, let's keep them rolling.
Deidre sent us this one. Back to reverse mortgages for a minute. I'm 60 and my husband is 71. Do we need to wait until I'm 62? I think you shared a way this could work on your podcast. What will happen to me if he dies first?
Hey, Deidre, another great question and another thank you. This one for listening to the podcast. So, and guys, you can find that at mrmortgageradio.com also. Each week after the show airs on the radio, Jen does whatever magic she does back there in the engineer's booth and puts it together as a podcast, strips the commercials out and just puts it up there as a podcast. And you can find that everywhere, right? Apple Podcasts, Amazon, what's the one? Pandora. We're everywhere. We're places that I'm even surprised play the podcast. But there's a link to the podcast at mrmortgageradio.com. But anyway, great question. So you don't have to wait until you're 62. Now, that being said, if you do wait until you're 62, you'll have more equity available to you because the amount of equity available will be based on your 60 years of age. But you can still make this work if you can be classed as what's called an eligible non-borrowing spouse. And what that means is you will have all of the protections of the borrower. What the main protections are is you're not going to have to vacate that property if your husband dies first, if you're an eligible non-borrowing spouse. Now, again, the amount of equity that is going to be available to you will be reduced because you're 60. They're going to use the younger of the two. And that's going to be true too. If you're 62, they're going to use the younger of the two spouses' ages. And there's a mortality table and life predictions and predicted appreciation. And there's a whole lot of math behind the scenes. But your age, your equity, and the interest rates are what the calculations are based on when determining the available amount of equity. And the younger you are, the less equity you're going to have because it's presume that you're going to live longer. But if your husband dies first and you're on the mortgage as an eligible non-borrowing spouse and you're on title, you're on deed as the wife, you're going to be afforded the same protections. You can stay in that property even after his death. So I hope that helps. This one confuses a lot of people because they think once my wife dies or once my husband dies, I'm going to have to leave the property. Yeah, that's not the case, guys. You would be surprised at how many misconceptions there are around the reverse mortgage product. So I always enjoy talking about the reverse mortgages, and now more than ever because, yes, inflation has slowed, but man, prices are still crazy. And if you're a fixed income senior out there and you have a load of equity, the reverse mortgage might make sense. I mean, we're talking to more and more people about it. And again, it doesn't always make sense. It's not right for everybody, but it's worth exploring if you're in a tight spot cash flow wise. So anyway, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing mrmortgageradio.com. That's mrmortgageradio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we're back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Hey, if you have questions or comments, please call or text 855-462-7292. That number is 855-462-7292. That's the Anytime Hotline. Jen is womaning the hotline, and she will be happy to get your questions on the air. Or head over to MrMortgageRadio.com. MrMortgageRadio.com. Click that big orange button right in the middle of the screen. It'll walk you through it. Just type your question in, hit submit, and Jen will read it on the air for you. But I want to keep this party going, if you will. We've had some great questions so far, and I know we've got a couple more back there. So, hey, Jen, fire away.
Rich emailed this one. Can I co-sign for my son's mortgage and give him a gift for the down payment? I don't have a preference between FHA or a normal mortgage, if that helps.
Hey, Rich, this is a great question, my man. Yes, you can. You can be, if I'm understanding the question correctly, when you say co-sign, most people mean they don't want to move in the property with their son. They're not a co-borrower. They're not going to be living in the property. It's going to be, in this case, your son's property. If that's the case, you're going to be classed as a non-occupying co-borrower, or as most people just refer to, a cosigner. Now, that being said, it's going to be on your credit. If he misses a payment, it's going to impact your credit, but he gets the benefit of both of your credit and both of your income profiles being used to underwrite the loan. So you can be a non-occupying co-borrower and gift him the funds for the down payment. And if you use an FHA loan, you can ask the seller for up to a 6% contribution toward closing costs. So congratulations on being in the position, or at least being willing to help your son, because as I mentioned in that opening segment, sometimes it's the stairs or the elevator or the escalator. They're all going up, and buying real estate over time has always made sense. So congratulations on helping him get started. But yes, to answer your question, you can do both. Hey, Jen, let's keep them rolling.
Anthony sent this. The more I hear about reverse mortgage, the more interesting they sound. Is it possible to get one on a condo? I don't have a mortgage now, and the value is around $600,000.
Hey, Anthony, that's a great question, my man. Sadly, I don't have a definitive answer. The answer is going to be maybe. And the reason the answer is maybe is the reverse mortgage programs, almost all of them, are an FHA loan program. They're insured by the FHA, and that's what kicks that non-recourse status into the loan, which prevents you from owing more than the property's worth, right? It's insured against that loss. So because it's an FHA loan program, the property needs to meet the FHA guidelines. So there's an approval process for condo associations. It has to do with things like the percentage of ownership for, let's say, an investment company came in there and bought a bunch, or a landlord bought a bunch of units, and those are rentals. There's only a certain percentage of the units that can be rentals. There's only a certain percentage of the units that can be owned by one entity. And then we get into the financial management of the association. Are there reserves? Are there adequate reserves? You know, all of the things that go into the approval process for a condo in the world of FHA also apply to the reverse mortgage space. So if the condo is FHA approved, then absolutely, you can do a reverse mortgage on a condo. The good news is it's not terribly difficult to determine whether the condo is currently or in the past has been approved, because it's not approved once and then never have to go through the process. You have to renew the approval with the FHA. And sometimes the changing of the guard, right? There's a new president of the association. They don't want to go through the renewal process. They don't see the value in having the association approved with FHA. And this is one place that it can be super valuable, especially if you're in an area or in a 55 plus building where there are a lot of people who could be eligible for the reverse mortgage. So the answer is maybe, and it's going to be determined by the approval status of the condo. And again, the good news is that it's fairly easy to determine whether the condo is currently or in the past has been approved. And if you need help with that, just shoot me an email and I'll be happy to research it for you. I'll just need, you know what, shoot me the address, because that'll be helpful. Then I can pull it up in the database to see if it is indeed FHA approved. If it is, you're good to go with the reverse mortgage. But great question. This one's a maybe, though. I hate the maybe answers, but that's all I got for you at the moment. Hey, Jen, throw me another question.
Jimmy sent us this. Can we use the landlord loan for a cash-out mortgage to buy more units? Do you still look at just the building's rental income?
Hey, Jimmy, great question. And yes. So you can do a cash-out refi with the landlord loan, and it's still going to be based on the income of that property. Not the income of that and the new property, the income of that property. And a lot of people do that. They call it BRRRR, B-R-R-R-R. And I know every time I say that, I sound like a seal. R-R-R-R-R. It's buy, rehab, rent, refinance, repeat. And the strategy around BRRRR is periodically pulling the equity out of the property to go buy another property, because increasing the value of the property and increasing the rents, mainly increasing the rents, will give you the equity that you can then pull out to go out and buy another property. So yes, long answer to a very easy question. The landlord loan can be used as a cash out refi, and a lot of people do that to go out and do, just as you mentioned, buy more rental properties. And you'll hear people refer to it as the BRRRR strategy. So I hope that helps. If you need more info, just touch base with us when we're not on the air, and I can walk you through it in detail. Great question. Hey, Jen, let's keep them going.
This one is from Alan. My father died last year, and I inherited the family's business. So now I'm self-employed. My bank told me I need 2 years as the owner before I can get a mortgage. Are there any special programs that might work before 2 years?
Hey, Alan, great question, my man. First, let me offer my condolences for losing your dad. I can't imagine that was easy. But what an honor carrying on his legacy and running the family business. So I hope everything is falling in place and you're doing well with that. I think that's super cool when a business lasts generationally in a family. What a cool thing for him to pass it to you, and a cool thing for you to carry on his legacy. So let me start by giving you some encouragement. If you worked in the capacity that you're in now, right? If you were your dad's right-hand man and you were helping him run the business, or you were operating in a similar capacity with another company, and now you're self-employed, you can qualify for a conventional mortgage with as little as 12 months self-employment history, with those caveats. So if you can meet those conditions and show that you worked in this capacity prior to taking over the company, then you've got a very, very good chance of qualifying after as little as 12 months self-employment. So I don't know how long you've been running the business as the owner, but just know that you've got a very good chance of qualifying after as little as 12 months. That's another one that gets a lot of people wrapped around the axle, is that self-employed borrower. And guys, with the self-employed borrower, if you can't qualify conventionally because you're not documenting all your income, or you are documenting all your income, but you've got an aggressive CPA who's writing a lot of things off and you're just not showing a lot of net income, there are bank statement loan programs with as little as 12 months, bank statements, self-employed, and there's calculations that use a percentage of your monthly deposits as income verification. So a lot of options for self-employed borrowers. So I hope that helps, Alan. Again, my condolences, but also my congratulations on carrying on the legacy. Very, very cool stuff. So I appreciate the question, though. Oh man, you hear the music? You know what that means? We are wrapping up another episode of the Mr. Mortgage Show. Man, this week flew by. Wow, that was quick. Are you sure, Jen? Are you sure we don't have another break in us? All right. She's waving me off the mic. Guys, I had a blast with you. I swear we have the very best listeners in the mortgage and real estate space on the radio. You guys asked a lot of great questions this week. If you need us when we're not on the air, check out MrMortgageRadio.com. That's MrMortgageRadio.com. All our contact info's is always there. The links to everything that we talk about on the air, that's MrMortgageRadio.com. Guys, have an amazing week. Jen and I will be back next week right here, same time, same station. See you then.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.